Today we're talking about the king of the banks, namely Royal Bank. Dividend investors, bonjour. My name is Mike Yahoo, and I am the founder of Dividend Stocks, and I'm also a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. Today, we are looking at one of my holdings, my second favorite bank, Royal Bank. We're going to look at their business model. We're going also to look at the role it plays in my portfolio. And at the end, I'm going to do a small overview about which kind of bank are looking interesting or not in terms of PE ratio right now. A lot of investors are telling me, yeah, Mike, I love Canadian banks, but they're on a roll in 2022. I'm not too sure if I should invest right away. Most of them are trading at their all-time high, which is kind of crazy, right? And then we all fear to lose a bit of money. So we're going to talk about that towards the end of this video. But first, let's talk about Royal Bank. A DSR rating of 5 out of 5, so a stellar buy, a great opportunity, and we're going to talk about why this company is so amazing. Dividend safety score of 4 out of 5. Again, very smart, very interesting business model. The company usually increase its dividend by 5-6% per year. Obviously, 2021 was a special year. Do not expect double-digit dividend increase in the future. I'm more like a conservative guy in terms of hopes regarding to dividend increase. So I'm expecting something between 5 to 7 per year, which is pretty good because Royal Bank is offering you a good balance between a decent yield at 3.3 and constant dividend growth and stock price appreciation. So definitely a great balance here if you're looking for some growth and some income at the same time. Canadian banks, they work in an oligopoly. There's 6 of them that deserve to be mentioned and small other players around it. What I like about Royal Bank, it's business diversification. If you look at US banks, most of them will be classic savings and loans, meaning that they depend on net interest income and that's about it. So whenever the economy is good, people are borrowing more money and then they make more profit out of those mortgages and those business loans, and it's the end of story. When you look at RBC's business model, 2021 net income, only half of their net income is coming from classic banking activities. So really talking about the P&C banking, personal and commercial. The other half is generated from capital market, wealth management, insurance, and treasury services. What I really like about this business model is you don't only depend on the economy or how interest rates are going. You have other ways to make money, and this is amazing when you look at what's coming up in the future years, because we expect a few interest increase for 2022. Maybe it's going to continue in 2023. So it's going to be good for any banks because the interest rate spread will increase. It's giving them more wiggle room, more margin to make more money on their loans, which is also a great growth vectors. But RBC doesn't just count on saving lane loans, they count on other stuff to do it. Their second growth vectors is capital markets, which is sometimes like a good thing and a bad thing at the same time because they are actively trading on the market. They're offering a lot of services there. So depending on what's happening on the stock market, they could generate a lot of profit or not too much. So you can see it took an important part of their business in 2021, which is great, but it's a little bit more volatile. What interests me a little bit more is the wealth management side. RBC over the years have created a wide array of services. They are trying to reach investors regardless if they want to have an advisor, they want to go with private wealth, or they want to manage their own stuff. They also have an interesting partnership with BlackRock, so they have iShares also. So they are present for ETF. They try to reach investors in all possible ways, which is quite interesting. And they are also very good on the US market. So as you can see, they made some acquisition in the past. They are now well established, and almost half of their revenue in wealth management is coming from the US. So sometimes when we talk about US exposure for Canadian banks, we think of TD, but Royal Bank is not as Americanized, if we can put it that way, as TD, but still they will benefit from growth from our southern neighbors. So keep that in mind when you're looking and comparing other banks. And I have another slide about how important the US segment is for RBC. It's coming up in a few minutes. In the meantime, one thing that is a risk, and a lot of investors must be aware of that, the exposure to the Canadian housing market. What you see on this graph is the exposure in terms of loans. So we can see that the largest portion of RBC loans is residential mortgage and ELOC, which are home equity line of credit. To get an home equity line of credit, you must have some equity on your house, and most of the time it will be given to the best clients. So I'm not too worried about default rate on mortgages and ELOC. However, if you think that it's going to continue to go that well and will be a growth vector in the future, well, one day or another, we might hit a plateau. The housing bubble may burst at one day as well, because we can see that in especially in great areas like Toronto or Vancouver or Calgary, the housing market is overeating all the time, but it seems that we cannot find the end of that story. So the bubble's not bursting. It even didn't have the same impact during the financial crisis of 2008. So I don't know when it's going to happen, but just keep that in mind. Royal Bank is highly exposed to that part. So you have to be a little bit more careful on this point, especially when you think about the largest banks in Canada like TD and Royal Bank. I told you about the US operation. I was quite surprised to see that now US operations are now 19% of net income for Royal Bank. So when you're thinking about TD, that has roughly a third, so 33% of their net income coming from the US. Royal Bank's not that far behind at roughly 20%. Most of it is capital market and wealth management. So again, it could fluctuate over time, but there's a strong exposure. So when you think about a bank that is greatly diversified in terms of business operation and geographic operation, Royal Bank should be part of them. Just want to have a quick note on the delinquency. If you look at what happens in the past quarter, the biggest risk is actually around credit cards and small business loans. It's kind of makes sense because small business loans, we know that like roughly 90% of them don't, of small businesses don't, survive the first 5 years of their operation. So if they had like small loans around it, well, the bank is going to take a hit. And for credit cards, usually pretty much the same. But when you look at residential mortgages and ELOC, it's very low. So what it tells me is if the economy slows down, what happened is, yes, banks are going to take a hit, but not that much. The thing is, it's more about the potential of growth that will slow down greatly. So even though interest rates are about to increase, which is a good thing, as I mentioned, margin will be better, so there will generate more interest in net interest income. Over the next few months, we're not going to see the impact on the economy. So for 2022, Royal Bank should generate a lot of good income from that. But going forward, you'll have to be a bit careful, because if people can't afford to buy those houses anymore, the mortgage are going to slow down. So new loans are going to slow down. So I don't think it will be at risk, but you will have less growth opportunities. So before we go into the role of Royal Bank in my portfolio, its dividend triangle, and which bank offers the best opportunity in terms of valuation, just want to take a quick note here to let you know that at Dividend Stocks Rocks, we have a team of analysts that go through all all the earnings summary. So right now they're very busy. They're working days and night to track over 1,100 companies paying dividend on the US and Canadian market, rating them and telling you what's going on in their latest quarter. At the end of that quarter, all our DSR Pro members will receive a complete summary of their portfolio, including the yields, the rating. We're going to highlight which stocks you should take a little bit more attention to, maybe some interesting picks, and also a list of replacement to make sure that you upgrade your portfolio, you improve it, and that you are safer. So if you are interested in looking into what this portfolio report look like, click down below. We have a link. You're going to have access to my own DSR Pro portfolio, so you have a pretty good idea of what I have in my portfolio, and on top of it, what it looks like, what they receive every 3 months. So it's a good way to cut down the noise, to avoid paralysis by analysis, and just to focus on what really matters, meaning reaching your retirement goal. Now, let's move on to what Royal Bank's dividend triangle look like. So as you can see, it's almost perfect. So we have a small dip for earnings during the pandemic, which totally makes sense. And at the same time, we had a pause on the dividend growth for that period, mostly due to regulators, because the payout ratio were still very good, still very healthy. You can see that Royal Bank is trading at its almost all-time high right now. So you may wonder if it's a good time to buy it or not. I still think it's a good time. We're going to talk about that in a second. But first, the role of Royal Bank in my portfolio brings a part of stability because of its relatively good yield, around 3.3%, and also some growth. As you can see, this company is all about total return, so you get more money in your pocket year after year from the dividend, but the stock price is also going up pretty much nicely. The revenue is on a uptrend. It's very steady. They have a bunch of growth vectors, notably interest rate, that are going to grow, the exposure to the US, capital markets, insurance is doing very well as well, and then wealth management. So you have this great diversification, a lot of organic growth, and I expect Royal Bank to continue to beat it in the upcoming quarters, do better than analyst estimates, and we should get rewarded by another good dividend increase in 2022. So now, a lot of investors, they tell me, yeah, Mike, but I'm kind of scared. Banks looks overvalued. They're not cheap. And then I realized that those assumptions are made because the fact that you look at a stock price graph and you realize those prices are like super high, right? It's like the highest in the past 5 years. So automatically you think, well, those banks are overpriced, right? And I'm not going to buy on them, and I'm just going to wait for a dip in the value. So what I did is I've pulled out a small chart, including the big 6 banks. So Royal Bank, TD, Scotiabank, CIBC, BMO, and my favorite, National Bank, obviously. I've pulled out the average PE ratio for the past 5 years, compared it to the current PE ratio and the forward PE ratio, so what we expect in the next 12 months. What you can see is that there's not much difference between the PE ratio and the average of the past 5 years. So the market is pretty giving the same valuation. So you see TD, Royal Bank, and CIBC are slightly higher. So we're talking like 6, 12%, 13% for CIBC. So it's not the end of the world. And if we look at the P forward ratio, so the next 12 months, now the difference goes back to 5 to 8% higher than the average. Again, not that impressive. It's not like a huge premium that you have to pay for those 3. And if you look at the other 3, so Scotiabank, BMO, and National Bank, they're actually trading slightly under their regular valuation from the market. So again, if you're thinking that banks are overvalued right now, they're pretty much getting the right valuation in terms of what they used to trade in terms of PE ratio. So considering the opportunity to strong dividend growth. We're talking like 5 to 7% per year for each of them for several years going forward. The organic growth that will happen throughout net interest income that will increase, and also some of them have great growth vectors throughout diversification, such as capital markets, wealth management, and insurance. I don't see why you would not be willing to pay like 11 or 12 times the earnings for such amazing banks. So again, my favorite, National Bank. Position number 2, Royal Bank. And I would say that if I had to add a third one to my portfolio, it will be probably TD, because I like its exposure to the US, and it's more like a classic savings and loan type of bank. So I kind of like this part, especially because Royal Bank and National Bank are so diversified and geared a little bit more towards wealth management and capital market. That could bring some kind of balance to my portfolio. Right now, I don't have any intention to add any banks, but that would be my number 3. So I hope that you have enjoyed this video. I hope that you have learned a few things about Royal Bank, and I am curious. Let me know which Canadian banks is your favorite. Which one is your in portfolio? Please don't tell me that you have 5 or 6 of them in your portfolio, because that's not over diversification. But let's drop a comment there. Let me know what you think about banks. Let me know if you like Royal Bank, and I'll see you in the comment. Until then, stay invested.